In this video, we make a comparison between valuation based on comparable firms and discounted cash flow methods. When we use uh, valuation multiplies to estimate the stock price for a company, we are relying on the market assessment of the value of other publicly traded firms with similar future prospect and similar business risk to the company that we want to evaluate. Okay? By doing that, the valuation multiplies do not take into account important differences between firms because we are using the average industry PE or the average PE from some comparable firms to value another company. But if there is differences between management of these firms or their manufacturing processes or the patents that they hold, we are not considering those, and essentially we are ignoring these differences by using valuation multipliers. For example, let's say that we have several ride sharing companies, and when we want to use the average PE of the ride sharing industry to value one of those teams, we are ignoring the differences between their management teams. If the firm that we want to value has a superior management team, that company will outperform other companies, and it might become the most valuable company in that industry. So the management team really matters, and if we use the PE ratio to value that company, we are ignoring the differences between the quality of management teams. However, when we use the discounted cash flow methods, we can take into account and incorporate specific information about the firms that we want to value. We can do that by incorporating these details into future cash flows and the cost of capital for the firms. The cost of capital was the appropriate rate to discount back the cash flows. Okay, so the discounted cash flow methods have the potential to be more accurate given that we have a right set of assumptions, realistic assumptions, and our estimations are reliable. Okay. So a final word about stock valuation technique is that we should not rely on a single method. All of these methods require some assumption and forecast. So said we should use a combination of methods that we have learned so far. When we have a combination of methods, and within each methods we have a range of estimates for the company, we can have a better idea of the real value of the company. We can see which of these assumptions may not be really true, or when our estimation might be not correct. So first, we should use scenario analysis and sensitivity analysis to come up with a range of estimates for each of the methods that we are going to use. And once we do that, we should use a combination of methods that we have. So the best thing that can happen when we have several methods is to have consistent result with through different methods, but sometimes that might not happen because the assumptions for each of those methods might be